So I hate to be the bearer of bad news here, but at some point, whether it's in the next 3 months or maybe not for another 3 or 4 years, but eventually there's going to be an extended recession. And not to be overly doom and gloom here, but given the recklessness of the government and the Fed, the next financial crisis could be a bad one. Now, I'm not saying this to scare anybody, but investors do need an actual plan for how they're going to deal with the next financial crisis before it actually happens. Scrambling around for a makeshift plan while it's happening is not going to be good enough. So let me share with you one of several ways that I'll be ready when it finally does and break down the VTS Strategic Tail Risk Strategy. If you want to see the strategy in action with all of the live trades, you can claim your free trial to VTS either down in the description below or also on my website. So the Strategic Tail Risk Strategy currently makes up 1/3 of our diversified portfolio. It's a systematic, rules-based strategy that only allocates capital to the asset class with the highest probability of success given the current market environment. And all of the signals are coming directly from my VTS Volatility Barometer. This is my own design of a comprehensive volatility index that's far more robust than anything else out there because it's a combination of over a dozen key volatility metrics. Of course, any single metric by itself could give false readings, but taken as a whole, this dramatically reduces bad signals. This is a chart of the volatility barometer values since inception in 2011. Now, it's a little messy to look at on a long-term chart, so I typically show it over several different time periods. This chart here is for the last 3 years. So the main growth engine of the strategy is the S&P 500, and we'll be holding the SPY ETF anytime the barometer is in its mid-range or below. That represents market stability, and long-term, this is where the stock market has its best performance. This chart here is showing only those S&P 500 positions within the strategy, and we can see that those occur on about 66% of trading days. Now, it has been an extended bull market, so naturally the volatility barometer will be spending a decent amount of time in that aggressive range. But the strategy is designed so that when that's no longer the case, and we're in an extended recession, then those equity positions won't be signaled very often, if at all. Members of the VTS community will see the trade dials for all of the strategies in every daily email, and this is what it looks like for the strategy when holding SPY. On days when we do have to change position, we just exit the current position and open a new one. Super easy to follow. Now, the second layer happens in that mid to high volatility barometer range. When it's here, volatility isn't elevated to the point of actually having to short the market yet, but it is a higher risk area and we definitely can't be taking aggressive positions anymore. So in this range, the strategy will usually be holding its safety position of the IYR real estate ETF. Now, I do say usually because when we are in one of those rising interest rate environments, you definitely don't want to be holding interest rate sensitive assets like real estate. It's very easy to know when this is. We can just map it right on to the Fed interest rate decisions. In rising interest rate environments, since we don't want to be moving into IYR, we'll just hold Coca-Cola instead. Coca-Cola is actually a really good defensive position to replace real estate just during those times when we don't want to take on interest rate risk. This chart here is showing the performance of just those safety positions, real estate or Coca-Cola, depending on the rate environment, and these occur on about 27% of trading days. This is the consistent performance we're looking for safety positions when it's too risky to be holding the S&P 500. And now I can highlight what makes this a tail risk strategy. Because anytime the volatility barometer is in its highest range, signaling extreme danger levels of volatility, we'll be holding the Chaos ETF. Now, Chaos itself isn't a very good buy and hold vehicle because it only performs well when the stock market is crashing. But that's also the only times we'll ever be holding it, so it works really well for us. This is showing just those Chaos positions in the strategy, which have flashed on about 7% of trading days. Pretty great performance for how rarely we actually need to hold this. And we do have to remember that this is happening when the stock market is crashing, so instead of bleeding capital, we're actually making a profit. How good would that feel during the next recession when everyone else out there is panicking? Your portfolio has found some stability. Going back to the volatility barometer chart since inception, we can see those levels only flash when we really need it. The European debt crisis, a little bit in 2015, the February Volpocalypse event, the Q4 2018 crash, the pandemic in 2020, of course, Trump's tariffs flagged some signals, but we're really just trying to protect capital and make a little profit during those all-out market crashes. That's the benefit of the VTS Strategic Tail Risk Strategy, targeted positions that match the current volatility environment. In my humble opinion, buy and hold investing was always dead, but especially these days with bonds having almost no chance to provide investors with any tail risk protection, tactical investing is the only choice left. Like I said, claim your free trial to VTS to see all of this in action. I'm very confident that I can help you achieve your long-term financial goals. So now you're ready to see how all of our strategies combine to form what I call the total portfolio solution. Again, no more than 5 minutes a day, but volatility targeting is the best way to ensure a smoother investing experience with a higher rate of return. So make sure you check out this video next. See you next time.